Okay, so welcome back now to another video on how to secure yourself financially. So looking right now at the Morning Star Investing Classroom, where you have this six course where you see things like featured content, stocks, funds, portfolio, bonds, ETF, and ESG. This environment, social, and governance. So on the featured content here, so the things to know and the quick recap, the TLDR on staying investment in the market is that stock has provided the highest return and the increase in the wealth, and investors must have discipline and patience during crisis and long-term performance. By looking at this 94 years examination of the past capital market return, I saw how holding on can pay off in the long run. And also the uh, uh, what happened after the end of a recession with stocks, specifically small cap stock, where market capitalization is around 250 millions up to 2 billions. The specific number may vary, right? But that is the range of this small cap stock. So, on average, after the end of a recession, small cap stock returns outperform those of the those of the large stock after 1 month, 6 months, a year, and 3 years after the end of a recession. And also by looking at the federal fund rate and how the US Federal Reserve tried to achieve the federal fund rate, which is an interest rate, and this is the charge or the cost of borrowing money or savings you will earn. So there are several type of interest rates reflecting different loans from different time length and risk. So in these loanable fund markets, you have short-term interest rates such as the federal fund rates, the treasury bill, and the one-year government maturity bond. So what we really care about this is the treasury or this federal fund rate, which is the rate at which commercial banks lend funds each other overnight. So, because the U.S. Federal Reserve, which was created in 1913, and now he said the discount rate, something I'm going to talk about that later, the prime rate is the charge or is the amount charged from commercial banks to their most creditworthy clients. They usually are companies. It also oversees the national banking system and uh, set monetary policy, prints money, and buy and sell government security in the federal open markets. And now this is the key because the U.S. Federal Reserve tried to achieve what is the interest rate at which banks lend fund each other, or the federal fund rates, and then it tried to achieve that rate by buying and selling security in the federal open market. And security is just a fungible financial instruments that hold some monetary value. So depend on the financial instruments, it can entitle the owner to a part of a company, usually called stocks, or it can entitle the owner to a principal plus an interest. they are called debt holders. So, for example, bonds are a good example. So, much like the stock market, the loanable or this bond market is also affected by the state of the economy. Specifically, the interest rates are affected by the demand of loans. So, during a contraction, the demand for loanable funds tends to decrease as their interest rate to stimulate consumer spending. And during an economic expansion, the demand for uh, loanable funds tends to increase as the interest rates. So then I look the market in terms and recovery to get a bigger picture of how the market performed, and especially this is useful for long-term investors uh, who wants to have this long-term investment and also see how risks decrease over time. So by looking at the market contraction and expansion that they have been 10 market downturns over the past 49 years, starting from 1973 during the oil embargo or the U.S. oil embargo made by the petromonarchy because U.S. were supporting Israel forces on the Yom Kippur War. That's a sensitive topic. That's a sensitive topic. And that's that is the range of how. So that was in 1973, right? During that, and well, by looking at the data from that period to 2021, we saw that there have been 10 market downturns, and each contraction or this each contraction, not downturns, and each contraction set the end of a market stock cycle, meaning a complete round price, uh, or meaning a complete round in a price stock fluctuation. So this economic contraction means when the stock market value peak fall 10% or more. And this can happen at random times and they can last for period unknown period of time. Whereas the recovery, which measure is the during an expansion, okay. So during an expansion, it measure is the recovery of an index from the very bottom of the contractions to its previous peak and the subsequent performance until the next peak level uh, arrive, or yeah, until the next peak level before another decline. So knowing that, uh, and the things to know from this section, okay, from the market and terms and recovery, is that investors should have a long-term investment horizon to allow their investment to grow. Okay, so right now I don't have any of those investment. Okay, but it's important to know if I would like to have them, right? So investors should have a long-term investment horizons to allow their investments to grow over time, right? Okay, because then I look at the market in terms and recovery. This was the thing that struck me the most because there have been several bear market and in the U.S. equity market. And the equity here is whether it's the total amount of is a total uh, is a total value or is it total amount of assets minus its liability, the net worth of a company or its capital. Uh, no, the net worth of a company that's different to the capital. So the net worth of a company, the amount of shares a person owns from a company, in the context of property, is the total amount of value minus its lien or this legal uh, right to someone else to possess your assets until you pay them or an obligation is made. So, for example, you have several type of liens like bank liens when you ask a loan to purchase a car. So they actually make a lien on that car until you pay that. So, for example, if you're unable to pay them, well, they will seize your car. Of course, this is not so dramatic, but if you don't show any signal or indication that you're going to pay for that, well, they're going to seize your assets and resell that to repay the loan. I like it. There's a business outside of there, but well, okay. We also have judgment liens that a judge can issue a lien to seize all of your assets. This is one most common on lawsuits. And uh, yeah, this is most common on lawsuits. And so, for example, a judge can issue a liens to allow the defendant in a non-payment case to liquidate some of the accused assets or all of them. You also have his mechanic liens, which is a guarantee that a builder, the construction firms or contractors is going to get paid by the owner. And in case it's not, well, you can go to the court and issue a judgment lien for that. You also have his real estate lien that is attached to a real estate property if a contract is not fulfilled. Okay, so for example, anytime you ask a mortgage to a bank, they automatically issue that liens on that home. So in case you're unable to repay that, they can seize your house and resell that or shuffle or whatever they do for that. This is another business in there, a pretty dark one business. In any case, uh, and also you have is the tax lien, which instead of being created by a law, is created by, uh, I mean, instead of being created by a contract, this is created by the law, right? And the most common scenario where you're gonna see this is on the taxation field. So if a delinquent taxpayer is unable or it doesn't show any indication that uh, yeah, it doesn't show any indications to pay, well, the tax authority, the IRS in this case on the US, after go through a lot of notification notice, well, they can is issue a legal claim to seize some of the delinquent taxpayer assets, such as the bank accounts, the property, and vehicles. Okay, so knowing that, all right, about liens, about equity, and how the market has passed through several bear market of these downturns and recovery, and the most severe It was at 1929, at the beginning of the Great Depression, where the stock lost over 80% of their value, 83.4%, and the recovery took 12 years. You gotta be kidding me. That's too long, man. Uh, that's generations. Back then it's like two generations. So more recently, in 2000, the stock lost 44.7% of their value, exactly, and the recovery took over 4 years, and this was the second largest in history. And when I look at the 2007 2008, during the banking and debt crisis, the stock lost 50.7% or 50.9%, and the recovery now took 37 months, more than 3 years. So by looking at this pattern and how uh, all of this recovery, how long all of this recovery, uh, how long all of this recovery took place, now I can decide, well, I'm not gonna wait for the market miraculously happen, right? In fact, I'm gonna create myself. I'm gonna improve. I'm gonna seize this moment that the only asset that I have is time right now. Okay. Okay. So the things to know here is that stocks are prone to sudden loss value for any reason. And how that was now the entry point for the asset class in downturns, but with respect to some asset class, right? Such as bond, stocks, some other asset classes with some sample portfolio, and look at the correlation of different assets with a broader market. So looking at the uh, I glance at bond yields during recession. So bond yields are driven by factors such as the demand and the supply and demand for loans, monetary policy, and inflation expectations. So the Federal Reserve has in its primary tools the uh, the Federal Reserve has in its primary tool is the uh, discount rate, is either the rate at it's either the rate at which the Federal Reserve charge banks for shorter loans, or is used to on the discount or the future discount cash flow, on the discount cash flow analysis. And discount cash flow is just an evaluation method here to determine the value of an investment right now based on its expected future cash flow. So cash flow is just movement of money in and out, and because uh, I just want to know how to read financial statement, because now I'm looking at the accounting aspect of that, all right? At least to know the basics of that, right? So the SEC, or the Security Exchange Commission, on their website, so they have this beginner guide to financial statement, and how they mention that if you're able to read nutrition labels or baseball or soccer box scores, you can learn how to read basic financial statement. If you can follow a recipe or apply for a loan, you can understand basic accounting. And the basics is not difficult. They're rocket science. So that section will show us how to read this financial statement, much like CPR class teach you how to perform basic cardiopulmonary resuscitation. However, being able to read all of this basic part of the financial statement won't train you to be an accountant, just like a CPR course will make you a doctor, a cardiac doctor, but it can give you confidence when you able to look at a set of financial statements. You can read them, okay? So it should give you some confidence when you're able to look at a set of financial statements and make sense of them. And that's the idea. That's the whole idea here. So these financial statements, they show you the money, right? So from the Cuba Gooding Jr. Immortal Lines from Jerry Maguire movie, show me the money. That's what financial statements do. Okay? So they show you the money, they show you where a company money came from, where is it now, and where it went. There are four financial statements. You have balance sheets, income statements, cash flow statements, and the statement of shareholders. So the balance sheets show what a company owns and what it owns at a fixed point in time. Income statement, how much money a company made and spent over a fixed period of time. Cash flow, the movement of money between the company and the outside world, okay? And the shareholders, or the statement of shareholders, show the changing interest of the company shareholders over time. So looking at the balance sheet, okay, where it shows you a detailed information about the company assets, liability, and shareholders' equity. Okay, so assets are anything that a company owns that has value. Either they can be used, yeah, either, yeah, they can either be sold, typically, or to be used to make products and service that can be sold. So, for example, you have physical or tangible assets and intangible assets. Okay, so tangible assets, there are things like inventory, tractor, land, equipment, whereas the non-tangible are, for example, trademarks and patents, right? Cash itself is an investment, and the investment that a company makes. Okay, this is all about the assets, right? Things that a company has, things that a company owns that have value, whether it's physical or not, tangible or not. Cash is another asset as well, and the investments that a company makes. Okay, so this is the assets. If you see yourself as a company, okay, and again from sec.gov, if you see yourself as a company, well, that is where your assets are. So the thing that has value for you, the thing that you own that has value. Okay, physical or tangible, intangible, cash, and any other investment you make. So I will make that clear distinction because anytime when I see an asset, I'm gonna use that as guidelines, right? So, okay, is this something physical or intangible? uh, or I receive cash, or this is an investment. These are assets from the company perspective. And the liabilities, okay, the liabilities are amount of money that a company owns to others, right? These include all kind of obligations, like money that the company owns from a bank to launch a new product, rent for use a building, money to suppliers, uh, payroll, a payroll a company owns to its employee, the payroll, environmental cleanup costs. So, for example, from the Ohio, uh, this tragedy that happened on Ohio recently in 2023, right? Ohio derailment report of health problem pile up. Okay, now it's not listed on first. Possible people injured explosion at Ohio manufacturing. Okay, that's another issue. But alright, Ohio. Spoken language, English and Spanish. Well, mm, interesting. Very, very interesting. In any case, so that is another liability is the tax you own to the government. Tax owed to the government. Liability also include any obligations to provide goods or service in the future. Okay, so when you talk about here of liability, which is not only the amount of money that you owns to other, okay, whether it can be uh, borrow you money borrow from a bank to launch new products, or the rent of use the rent for use a building, money owns to suppliers for material, for example, payroll a company owns to its employee, uh, environmental cleanup costs, or tax you onto the government, right? But also any obligations to provide goods and service to customers in the future. For example, insurance. Okay, uh, so that is liabilities. And then I look at the shareholders' equity. So this is the uh, sometimes called net worth or capital here, according to this. So shareholders' equity is called capital or net worth. Okay, so it is the money. It is the money investors. Mm, I know. I mean, this is shareholders' equity. It's a complete thing. The shareholders' equity in the balance sheets, it is called net worth or capital. Is the amount of money left if a company liquidate all of its assets and pay off all of its debt. So the leftover money belongs to shareholders or owners of the company. Okay, so this formula here of the asset is equal to the liabilities and shareholders' equity is the formula used on the balance sheets. Okay, whether you can find that uh, all the company asset list listed on the left side and the company liabilities and shareholders' equity listed on the right side. You might also find, for example, like Yahoo Finance, they put at the top and list all of the company assets, followed by the liabilities and shareholders' equity. So the now to look up the balance sheet. Okay, so assets are generally listed by by how quickly you can convert that into cash. That you have current and non-current. So current is uh, assets that are likely to be converted, or they can, or the company expect to be converted into cash within a 1 year. Okay, so for example, inventory, non-asset or non-current assets are uh, things that a company is not expecting to sell. Okay, are things that a company does not expect to sell, or it will take longer than a year to do that. So inside of this non-current asset, you have fixed assets. Okay, fixed assets are those assets used to operate. Exactly. So inside of the non-current asset, you have fixed assets. And fixed assets are those assets used to operate the business. These fixed assets. So fixed assets are assets that are needed or that are used to operate the business, and they're not for sale. So for example, it can be truck or furniture, office furniture, equipment. In my case, it's equipment. For example, my laptop, keyboard, mouse, mobile phones. These are things that are not for sale. Okay, and liabilities are generally listed by their due date, and you have is current liabilities or long term. The currents are obligations that a company expect to pay off within a year, and long terms obligations do more than 1 year. And you have is the shareholders' equity. This is the amount owner invested. Okay. This is the amount owner investment in the company stocks plus or minus the plus or minus uh, company earnings or losses. Okay, company earning or losses since inception. So sometimes companies distribute earnings instead of retaining, and this is called dividends. And again, the balance sheets show a snapshot of a company assets, liabilities, and shareholders' equity at the end of the reporting period. It does not show the flow in and out of the account during the period. Income statements is a report that shows how much revenue a company earned over a specific time period. Okay, but now this is looking at the income statement. But again, after I make this quick recap of the balance sheets, okay, so where it shows you detailed information about the company assets, liability, and shareholders, so what assets means for liabilities and shareholders equity, how it is organized in this sheet, whether on the left or the right side, or you can find on the top where all of the company assets are listed, followed by the liabilities and the shareholders equity. In what is how these lists are organized. So they generally listed by uh, how quickly you can convert assets into cash, whether it's you have current or non-current. So meaning how quickly you can convert some things within a year, current assets such as inventory, for example, or non-current assets where it took more than 1 year, or there are things that are not for sale. And inside of non-current assets, you have fixed assets that are used to operate your business, and they're not for sale. And when it comes to liabilities, where this is generally listed based on the due dates, so you have current and long term. So current are obligations that companies expect to pay off within a year, and long terms uh, do a more than 1 year, right? And the shareholders' equity, where it show the amount of money invested by the owners in the company stocks, plus or minus the company earnings or losses since inception. Sometimes these earnings are distributed instead of retained, and they call dividends. But the general guidelines or the things to know of this balance sheet is a snapshot of the company assets, liabilities, and shareholders' equity at the end of a reporting period. And it does not show the flow in and out of the account during the period. So now that solidify is our knowledge on balance sheets. Basically, anytime when I see a balance sheet, I know what it is, what are the data that I'm looking, and how can I make sense of them. So by looking at these balance sheets, I can have some confidence to make sense of all the data that I'm looking for. And not only that, but also apply it to myself. Okay? In the case we want to create a company. Cool. So let me make a pause here. No.
Salí a la calle Argentina a hacerle.
Mhm. Okay. So right now I'm going to make a quick recap of the income statement. Okay. So an income statement is a report that shows how much revenue a company may earn over. So an income statement show is so an income statement is a report that shows how much money a company made. Is a revenue. So an income statement is a report that shows how much revenue a company made, uh, and the cost and expense associated with earning that revenue in a period of time. So the literal bottom line of this statement usually show the company net earning or losses, and this tells you how much company made or lost over that period, whether it's annually, quarterly, okay. But this income statement, okay, is a report that shows how much revenue a company made and the cost and expense associated with earning that revenue in a period of time, whether it's annually, quarterly. So the bottom line of the statement show the company net earnings or losses. So this tells you how much a company made or lost during that period. Okay, makes sense. And after all, the income statement show you how much money a company made and spent over a period of time. Okay, but this is more a detailed explanation because it tells you is uh, that how is the mechanism, the know-how of this. Okay, and that is well, um, yeah, and that is the um, well, this is a report that shows you how much revenue a company made and the cost and expense associated with earning that revenue in a period of time. So whether it's quarterly, annually. So the bottom line of that show you is the company net earnings or losses, and this tells you is how much money a company made. Okay, so the income statement also reports something called the EPS, the earning per share, is a calculation that tells you how much money how much money a shareholders will receive if all of their how much money a company will receive if all of their earnings were redistributed. Okay, or if a company decide to distribute all of their net earnings for that period. They usually don't do that. They yeah, they usually uh, yeah, companies almost never distribute all of their earnings. So usually they reinvest them in the business. So to understand how income statements are set up, think of them as a set of stairs. Okay. To understand now how the income statements are set up, think of them as a set of stairs. You start at the top with the total amount of sales made during the accounting period, and then you go down one step at a time. And then you go down one step at a time. At each step, you make a deduction for certain costs. Again. So to understand how the income statements are set up, think of them as a set of stairs, where at you start at the top with the total amount of sales made during that period, quarterly, annually, all the total amount of sales during that period. And then you go down one step at a time, and each step you make a deduction for certain costs or operating expense or other operating expenses. So each step, so then you go down, and each step you make a deductions or other expenses operating or other operating expense associated with earning that revenue. And at the bottom of the stair, after deducting all of the expense, you can learn how much the company actually earned or lost, how much the company made money or lost during that accounting period. And people often call this the bottom line. And with that, that'll be all for this video. Take care. Bye bye.